So we thought that when we came into 2024, that a new day would dawn and we would start to see some insurance companies in California picking back up on selling home insurance in the areas where they have stopped selling new policies and where they've been non-renewing people. But that has not happened. Unfortunately, it's been more bad news. The Hartford, which is a company that is in partnership with AARP, the American Association of Retired Persons, so they insure a lot of seniors, announced that they too were going to stop writing new policies. So they've joined State Farm, Farmers, Allstate, many of the big brand name insurers in saying, yeah, we're at our what we feel safe in terms of our capacity to insure residential property risk in California. We're not going to eat anymore, as it were. So the pressure is continuing to build on consumers, on the insurance commissioner, and on lawmakers who are hearing from their constituents every day in mostly rural and suburban areas, but increasingly in some of the urban areas where I'm based in San Francisco. My neighbor got non-renewed. I'm hearing more and more people having to shop right now. And being really surprised. So the situation is remaining very, very dire. We're waiting right now for the Department of Insurance to issue a set of proposed regulations. And that is supposed to happen any week now. And that should start to move things around a little bit, we hope. Insurance companies want three things. They want to be able to put a rate increase into effect as soon as they feel that it's necessary. And so they don't want to wait for regulatory approval. That's number one. Number two, they want to be able to start using something called CAT models, which is a tech tool that would take the place of some of their more traditional predictions about what might happen in the future at causing claims. They want to be able to use models that data scientists have built that purport to see the future better than the old ways that we were evaluating risk. That's number two. Number three, they want to be able to pass along to their customers, to consumers, the cost of the reinsurance that they have to buy for their very high dollar catastrophic risk potential exposure. So those are the three things that they want. And they've run up against our consumer protections in California and our approach in California. So California has a very professional insurance regulatory agency. They're a strong regulator. There are some states where there's like 5 people overseeing the insurance industry. In California, we take it very seriously because we're a big state. So number one, we have a very strong insurance regulatory agency. Number two, we have a one-of-a-kind rate regulation regime here. We have something called Prop 103, which the voters put into place in 1988 on the ballot. And that beefs up our regulation even more than traditional regulation. So that Prop 103 has all kinds of pieces to it, but the main piece is that there are restrictions on the factors that insurance companies can use in their rates. They're not allowed to use credit score, for example. Then there's a process for getting your rate approved. If you want to increase your rates in California, and if you're an insurance company and you want to increase your rates, you have to file a new rating plan. Then the department will look at it, and under Prop 103, they look at it with a fine-tooth comb. And there's an intervener process where if a party wants to intervene on behalf of the consumer, they can join and they can ride herd with the Department of Insurance. So you have the Department of Insurance looking at the rate increase request, and then you can even also have an intervener in the same process saying, oh, what the insurance company wants to do is not right. So you have a couple of layers of oversight of insurance company rates in California that you don't have in other states. So before we had a series of very damaging, expensive wildfires, starting with the 2017 fires in the wine country, then followed by the Thomas fire, the Woolsey fire, LA, Malibu, big homes going down. Then the Paradise, the Camp Fire, with all these record-breaking fires. Before we had those happen, and before we had inflation and COVID, some of the supply chain interruption, price and labor increases that COVID-19, another great gift from COVID-19. Before those things, the Prop 103 was actually helping consumers, because it was keeping our rates at a good level. Like we've been on the bottom, third of insurance premiums across the country. California has been about there. And so Prop 103 has been helping consumers a lot with affordability. But once the market started to get, competition started to get weak, and insurers, all these other factors came in, and insurers feel this pressure to charge more quickly, so they feel like they have enough money in their coffers to pay for what might be coming, then the friction started to really amp up. Insurance companies have never liked Prop 103 because it's an extra step for them, right? Now they're saying, we are not able to do business here because it's taking too long for us to get our rates approved, right? So that's their main argument. Plus, they're saying, you're keeping us outdated, right? By not letting us use these CAT models, you're holding us back from using the best technology to see into the future, right? To price risk. And then third, they're saying we get to pass along our reinsurance costs in other states, but we don't get to do it here. Therefore, we want to do business in other states, more business in other states and less business in California. That's a lot of what they've been saying, right? So what I'd like to see as an advocate for property owners throughout California and throughout the nation is for the middle ground, which is, let's look at any opportunity that we have to bring efficiencies into the rate review process. Does the department have enough hands on deck? We know they don't. We know they need more, but they say they have the money to hire. They're just having trouble hiring. So that problem is on the road to being solved. They are working on getting more people on deck so that they wouldn't be as reliant on interveners, that they have their own ability to determine whether a rate increase is fair and whether it's appropriate, right? So looking for efficiencies, we want to get those rate increase requests processed quickly, but we don't want the department doing a superficial job and just rubber stamping a rate increase request, right? We want to make sure, we know from history that insurance companies tend to overreact to their perceptions about what's happening, right? So we know that they are being very conservative about projecting how much money they need to charge in order to stay profitable. So we want the department to be able to have the resources, have the people power, to be able to, when an insurance company files a rate adjustment plan, we want our department to have the ability to get right on it, parse it, pull it apart, question the assumptions, sit down with the insurer, work it out, get it approved at some level, move it through, right? That's what we want, right? We don't want things getting bogged down. There are things that insurance companies could do to get their rate increase proposals approved more quickly. We hear that they often don't put in a complete filing and the department has to come back and they have to go back and forth. So there's a lot of talk about sitting down and with insurer representatives and the Department of Insurance, and ideally consumer advocates, and finding places where we could be more efficient. A lot of that has not been happening because the political temperature is very high. People are angry. People are pointing fingers, and we need more dialogue to get to a restored, competitive marketplace here in California.